I've been working currently as a professor in commerce and management in Mysore. Uh, my total years of teaching experience has been about 8 years, and I've been in the industry for the last 5 to 6 years. Through this PPT, we are going to see about what is the importance of financial modeling using Excel. Now, when I talk about financial modeling, it is not more about the financial professionals or more about the numbers as in what we talk about, but this is more about understanding from a general perspective as in how finance can actually help people in terms of understanding the numbers, how we can use Excel effectively in terms of crunching the numbers and making the presentation much more effective. Now, going forward with the slides, the most important part for any company today is that decision making, and that decision making comes with an amount of risk, an amount of you know uh, turbulence which starts coming inside when you talk about finance. Now, every major decision a company makes in one or the other way, when we start looking into it, there is an amount of risk, uncertainty. Should I go about this project? Can I invest money in this project? Is it really valuable that we start putting money into it? Will the return on that particular project will come out? All these questions starts coming inside. So the valuation, as in the outcome of that particular project, the return on investment on this particular project, becomes a very big challenge. So what would be my future cash flow levels? What would be the risks that are involved in these cash flow? Whether they move from assets, the quality of debts, what is the kind of equity, what is the kind of F&Os that we are going to manage, and how am I going to measure the real value of this project? All these things, when I keep speaking, might be like, they sound complex. They sound something which is, this is not my cup of tea. I do not belong to this number game. But then when we start looking at from a day-to-day operation, this is what probably each one of us do in our own ways and methods. For example, if I belong to HR, I would start calculating finance from an headcount basis. Now, I do it in a very simple manner. I would probably start thinking, if I'm going to recruit 10 people into my organizations, for that 10 people, I need to pay salary. So this would be my per head outcome for a month. So that means multiplied into 10. So I start doing some number game. And finally, I come at a figure and I go to my top management and I start saying, probably this would be the cost or expense for us in the coming years. So similarly, each one of us would start doing something or the other in terms of finance. The end game of this financial exercise is to see that where is the cash flow coming in for? Is it really working out in terms of revenue towards the company? So we are going to measure that outcome, and we are going to start understanding whether this financial valuation using the tools that are being provided to us are really going to make a great amount of advantage, a great amount of value addition in the long run. So going forward with that, what is the outline on which we are going to look into? We're going to develop a structure, a layout of alternate types of models. I'm not going to go real deep into the model kind of thing. I'm just going to tell you what are the basics in which we are going to do it. Some of the programs and practices that have been followed and done on the current levels. There is the time periods in the model. We also talk about value drivers, model inputs, and we are going to talk about the major factor called as cash flow, the waterfall balance models, and some of the auditing tools that are going to come in. So, in a nutshell, if I have to put across this outline, I'm going to talk about what exactly are the methods and what exactly are the features that we are going to put inside to find out whether the company's financial health is in a healthy position, is in a green line, what we talk about. Now, is financial tool purely a statistical model, or it is more about a management exercise? This is somewhere, we have to take a call. In developing a financial model, the most basic thing is that people talk about, it's all about formulas, it's all about numbers, it's all about, calculators, and it is all about using all those advanced Excel or SPSS tools. But let me tell you in a very simple way, it is primarily about understanding the business first and understanding the each and every function, how they are related. Now, in an organization, when I typically draw a chart and I say that there are four functions, I talk about finance, I talk about marketing, HR, and then I talk about systems, which means the four tools or the four components are interlinked, and each one of them are considered to be a cost center. Each one of them have their own revenue cycles. Each one of them have their own inputs and deliverables. So which means each one of them are a vertical which will have its own cyclic model to work. This is where we start understanding that the entire financial model is more about understanding the business, putting it together in such a fashion that finally we are able to derive something valuable for the company. So as the slide goes on, we start understanding the most important function in financial modeling is the word called as forecasting. Moment you start predicting, you start forecasting, you start getting a feeling that we are going to go upwards, we are going to go downwards, whatever is the factors that are going to come in, the business functions and the business heads start getting the signals. They start understanding that there is some sort of analysis that is going on. The whole idea of putting this financial modeling is more from a quantification purpose. This is very clearly needs to be understood, which means uh, if I talk something today to the management, the question that lies behind it is what is the value on which I'm talking? What is the number? What is the quantification value which I'm talking about? I cannot talk an idea in the air. I cannot talk something philosophical in nature always. I cannot go to the management and say that we need to improve our logistics. We need to invest in R&D. All these kind of opinions or thought process come with a cost, come with a monetary value. So what is that monetary value am I talking about? And that's where statistics come in, where I put in a set of values and I tell to the organization, this is the cost, this is the revenue expected, and probably these are the factors or challenges that are associated when I'm going to put into an investment in these functions. So primarily, financial model is a statistical tool, but it is not that complex. It involves numbers which are being put in a logical sequence to make the management understand what is going to be the plus and minus in terms of investment and in terms of returns. Any questions, any doubts, anybody would like to share their opinions here before we start going into a component factor, right? Let's start understanding the model that is being displayed here. We start with a historic financial data. This is what everybody loves to do. Why? Because the first thing that anybody loves to talk about in finance is a word called as a balance sheet. Now, what exactly we do with a balance sheet is more about not just the numbers, but it is more about indicators. What does your balance sheet actually talk about in the last few years? Does it talk about all plus, or does it talk about all minus, or does it talk about that this company is work in progress kind of model? So the historical financials are the base that will give you the platform to understand what we are going to do in future for the betterment of the company. So the historical financial will basically give you something called as inputs. That inputs will actually move you towards a working sheet, which means we start understanding the revenue, the expenses, what is the capital expenditure, the working capital, depreciation. These terms are not something new to us. These are something which are very common, which I'm talking about as in to understand what has been the company's working model. 100% of the time we always have this question, what is the existing debt of the company? Now whenever we start a company, there is a liability that is being attached, a limited liability that is attached to the company. So we need to understand the plus and minus, the typical assets versus liability. What is the existing liability and what is that we are currently working upon? After I do this initial calculation, I start moving into something called as beginning of balance sheet and financial statements, which means this is where I am actually trying to restructure, realign myself, start working on the fundamentals. I am not started getting into the analysis part of it. I am just trying to put on the headings in a very clear manner so that anybody who's going to get into an audit level of my company starts understanding what we are exactly doing. So my financial statements are primarily indicators which will give out one side the cash flow, the other side the value, credit, and quality. So from an auditor standpoint, when I start looking into my balance sheet, I do not just look into the monetary aspect. I look into the health of the company. I look into the company as a future potential for growth. So I start looking from an angle where I see that what is the existing cash levels? Is the company having too much of liquidity? Or is this company more an asset based kind of company? Is this company trying to invest more and more money into new projects? Can this company be a potential interest for investors tomorrow to come in and start putting in money? So I have, multiple question marks on the balance sheet just to make the balance sheet more interactive for me and for the investors. So in a long run, I start looking that the outputs are more value oriented, more credit oriented, and more quality oriented. I'm not just number oriented. I do not want that, because number orientation will only give me figures which can be interpreted in any format. But what a modeler or a financial evaluator would start looking is what is the long-term value by investing in this company? What is the credit rating of this company? When I go tomorrow to a bank or to a venture capitalist and I show my balance sheets to him, I say that what is the credit value, he would start asking, and what is the quality of financial statements? What is the quality of the company in terms of operations and the financial generations that I've been doing in the long run? So that's how my corporate model looks when I typically talk from a financial aspect. Moving on, the basic model logic of a standard corporate model. Now, as a corporate in institution, the first thing I would always love to talk about is the word called as cash. Is the cash coming inside? This is a question which everybody tries to ask. Why? Because if I am an investor, I'm a venture capitalist, I have funded a company today. The one question which I would like to ask the CEO and managing director is that what is your cash flow? Where do you see your revenue model? Now, probably this question cannot be answered overnight. This question is not something which I can answer at a flash of a light. But then I would try to be as simple, as ethical, and as logical possible, where I would start putting in a straightforward model to my VC, to my investors, saying that what exactly is happening to determine the cash flow. So if I start building up a model where I first start accounting for the company's financial structure, the existing debt, the areas where we think that revenue can be generated, expenses, and then finally I put a model which would tell me what would be the exact cash position in the company. So if the flow is able to tell me exactly where the money comes in, the earnings and the financial ratios for valuation, automatically I'm able to come to a standard corporate model which would tell the investors and the bankers that this is exactly what I would be able to earn in a year, and these are my areas where I would need to focus more, or these are my liabilities where I need to concentrate. My focus on a model should be on value drivers and development of the assumptions, which means, I am trying to look into a company where I'm not just, a short term oriented, but I'm more on a long term, and whatever assumptions which I'm building in. Now, the word assumption here has to be clearly understood. The assumption is something more on the risk and the challenging factors that are developed on the balance sheet aspect. I'm not worried about this factor that I'm trying to make something which is fictional value, but I'm more on a risk factor value. So I'm primarily talking that this model which I'm trying to develop would have certain risk factors inbuilt. Keeping that risk factors, keeping the macro environment in which I'm working and the financial conditions that are existing in and around that particular setup, I'm going to go back, I'm going to develop a basic model which is very, very logical in nature, and then go to my auditors as well as my bankers and venture capitalists and tell them this is where you can look into money inside my company. If they are understandable, they are okay with it, and they start finding that this company is going to generate revenue in a short period of time, say by 1 year or 2 years or 3 years, whatever is the prediction that has been given here. Then they start understanding that this company is financially valuable, this company is financially interesting for me to go ahead and give a green signal. 90% of the time, this financial model, I would also like to put it in the areas of a business plan. In a managed in school, whenever we talk about the creation of business plan in any of the corporate games or any of the B school uh, festivals or functions, whenever it happens across, whenever we talk about this business plan, the students misinterpret the financial planning just as putting numbers. They say that the company will generate a revenue, the company is worth so many rupees or dollars, whatever is that. But the exact thing that a valuator or a judge or a person who comes to the B school festivals or carnivals, they start looking at this point. What is the financial modeling you are trying to adopt? What is that you are exactly trying to tell? So when we have a short limited period, we need to more concentrate on a financial model rather than just drawing a superstructure of the organization. So the logic of developing a financial model, as we understand here, is primarily from three areas: one from the cash flow, two from the existing debt, and three from the revenue generation in the long run. If these three things are clearly put across, probably that itself makes the business plan more accurate, more reliable, and more interesting for a venture capitalist to start understanding. Probably not all the business plans get selected, but then when you make a business plan more logical with your cash flows and your financial structures modeling inside, then I think the VC starts spending a few more minutes and starts understanding that yes, this guy has done a bit of homework, this guy has tried to understand the financial aspects, and then he starts putting across. So in this way, the entire modeling becomes more interesting for all of us. Going forward, the cash flow process of a corporate model. This is quite interesting for all of us to understand. Why? Because I would not like to start directly on the balance sheet, but I would like to start with something called as the income statement and your cash flow statement. Where does the income statement and cash flow statement start generating from? It starts from the fixed debt issues. What is your fixed interest expense, your debt maturity, new issues, and your debt balance? What are all these components? Let us look each one of them in detail. Now, when I say that there's a fixed interest expense, that means the company has got by nature, when I talked about the limited liability part, company by default has got something called as a fixed interest expense. Because I have borrowed money on a particular rate of interest, I need to start paying it. 99% of the companies in the world are always being sponsored, invested, and they have been put across from a liability standpoint. They're not companies which would be generated on a self cash basis or something where you put in the 100% of kind of thing. So what is that fixed interest expense I have every month? And that might be a figure which might be on the higher side or on the lower side. What is the maturity level of my debt? See, for example, if I hold a debt for a longer period inside a company, automatically, the debt starts going up to such a level, the interest level expenses also start going up. If my debt maturity is on the kind excuse me the lower side, then I do not have to worry much and I can start moving forward. What are the issues that are coming up with the balance sheet? What are the challenges in terms of understanding the debt? And what is the generation of income and generation of expenses that are being shown outside? All these things matter a lot for us. Why? Because from here we are going to start looking into the income statement, then to the cash flow statement, and then we start moving into the balance sheet. Now, first thing, the income statement. Everybody loves to talk about income statement by large. What is income statement all about? Is it just about the money that's going to roll inside the accounts of the company, or is it something more to do with the short term, long term, or is it something that is just going to talk about income minus tax? I would say it's a mixture of all. So the first thing what we would start looking is that what is the earnings before interest and tax, the fixed interest that comes in. Short-term interest, there's a lot of short-term borrowings that will happen where, typically the company might go under a cash crunch position, so you need to borrow money. Again, you need to put it back. So you have the short-term interest rotating kind of thing. You would put some money back in the bank just to generate some income for you. You will have an interest income coming inside. And finally, we arrive at the net income. See, if you start looking at those companies which have been for a long-term existence, and you start seeing these companies, having a lot of cash deposit, probably the income that is being generated for this company through the word called as interest itself is on a very high scale. That's quite interesting for all of us to visit today, because if the interest income that is being generated from your previous savings and your previous statements that are being generated itself is on the higher side, then the company do not have to worry about the debt fact. It has enough cushion, or it has enough backup, so that that income statement is able to push back all the debts into the market. Second thing is the cash flow statement. What is your net income, depreciation, your net cash flow that starts coming in? This is quite important for us. Why? Because this will tell you the present position of the company. There are companies which are saturated in nature, what we call in the typical management term as cash cows. Why? Because they have made enough money. They've got money more than what has been expected all throughout, and they have been trying to push the market to a very great extent. Now, what happens here is that you might see that the cash flow statement would start generating all sort of incomes, all sort of depreciation values taken into factor, and what is the maturity level of the debts that are being going through. So finally we arrive at the net cash flow. This is what my company is able to generate year on year, quarter basis, or on a half yearly basis, whatever would be the cash flow statement. And that is very important. Why? Because that tells whether the company is still active, or has it hit a saturation point? Is it on the growth stage, or is there a possibility that, yeah, I disinvest the company and start something new? So this cash flow statement would be a very, very prime indicator for any of the investors to start looking into the company. Finally, from there, I jump into the bottom line of the story, what I call it as the balance sheet. So if the balance sheet tells me that there is surplus cash, there is common equity patterns, there is a lot of share capital, there's also a lot of net worth that remains inside the company. What I typically mean by saying that the liquidity factors are very high for that company, automatically the balance sheet starts looking heavier on one side, and the balance sheet would start responding to the investors saying that there's too much of idle cash remaining inside, so we need to do something for that. So the net cash analysis, that's where we move inside and start understanding what can we do with the net cash flow. Can I start investing? Can I start making something better for the corporates? Can I start putting it into something more valuable? Common pattern analysis. Can I start looking into new businesses that are coming in? Or should I, take back the money and reinvest it in the market? All these kind of things. So this is where an Excel or an SPSS tool starts coming into picture. The modeling pattern will start getting inside where we start putting in the macros. Macros means are, the shortened programs which are being generated for specific purpose, and they would be able to tell us exactly what are the factors or parameters on which the company would be evaluated. For example, if I start looking at net cash analysis here, it talks about cash minus short-term debt. So I would use the beginning balance, add the cash flow, the ending balance, and then I would start understanding what is the flow level currently happening. This would actually tell me what is the net amount that is remaining in my hand. This is highly, highly important at one point of time. Why? Because people start asking this question, where exactly are we trying to build this balance sheet, what exactly is going inside the company, and it tells you what is the position of the company. Many a times it becomes that, the company looks healthy, the valuation is fantastic, but then the company is running short of cash. It doesn't have immediate cash to, expedite the expenses, and you need to wait. So the net cash analysis can be a tool, can be an indicator that can be developed using Excel, a simple macro to be written that can tell you exactly the position of the company there in terms of the net cash analysis, in terms what is remaining in the hand at that particular point of time. All these subheadings which I'm talking about could itself become a tool or an indicator on your Excel sheet, and on a tab, on a click, you would be able to see what exactly is the position of the company. So finally, I'm going to put in the huge chunk of financial data into a nice presentable form of Excel, and I'm going to project it in this manner, where I'm going to talk about inputs, I'm going to talk about debt schedule, working sheet, depreciation, source and use of funds, annual financials, and from there the outputs. Now this is where exactly the management steps in, and management becomes more interested to talk about the finance. Before I proceed, I would like to ask anybody any doubts, questions. Would they like to share any ideas here? Okay. Going forward, I would just like to talk about this project financial module. As I was talking about how management gets interested here, these are the tabs that are being inbuilt on an Excel sheet or on an SPSS model. So moment I look into the graph, or moment I look into the tab sheets, I would start looking my cost versus revenue. So typically I would start looking into the technical parameters of the capacity, the prices on which I'm going, and on the other side, I would start looking into my cash flow. What is the free cash flow? What is the equity cash we are generating? Where the source and use of funds coming in? At this point, I would like to bring in an example. If you look at the great computer company called as Dell Corporation, 90% of the time, the working capital would be on the negative side. The reason is that it doesn't mean that the company is going down under kind of thing, or the company is not doing well. It's an extremely sound company in terms of the hardware business, and they have been doing extremely well when it comes to IT services. The only reason is that they always keep the cash only for an use and build model. It's primarily because Dell always believe that you don't have to infuse fund every time, keep it locked kind of thing. Only at the time of usage of funds, the necessity comes in, they pump in the funds and they take it forward. And most of their capitals and the revenue sources that come in is from directly from the sales. That's why they came up with a model called as Dell Direct, which means they would avoid all the middlemen, and whatever cash flow revenue would be directly recognized by the company's balance sheet. So their cash flow was pretty much higher when compared to that of the predictions. And this is exactly where we need to understand that a management typically looks where is the source that we are generation and where is the usage of fund. This tab is very, very important when you do a financial modeling. Tomorrow, when you are starting a company, or when you are on the midway through your company, you will start asking this question: what is the source and what is the end of the source? Where I exactly use the funds. Sometime down the lane, people are amazed by the factor that I have multiple sources where I can generate money. Today, the sectors are much more streamlined. Today, you have multiple sources where people are interested in putting money in startups. But then, how do you use the funds smartly, intelligently, so that you are able to drive it towards a positive cash flow, makes you a successful financial manager. So the sourcing alone today will not be a challenge. The usage of funds will be still more a greater challenge, which will actually put you towards the free cash flow, the equity cash flow valuation, and start telling you how my financial models are working. So you need to understand what kind of factors on which you are building your company. For example, if your company is too much built on suppliers, the dependency is too much on the suppliers, and the delivery side, the logistics side, on infrastructure side, that means you need to understand that the fund value or the free flow cash value will also get equally affected, because there are a lot of cycles through which it has to go through. If your company is more on a service side background, where you are more dependent on the intellectual capital of your organization, that means there is a greater chance for you to break even faster, provided the idea clicks on very well. On the other hand, if you're a manufacturing unit, you are probably a company where you need more usage of funds, and there will be always a cash liquidity that will be needed. Why? Because you need to rotate it through the multiple units of the organization. So like this, the model of the company, the business model of the company and the financial model of the company are directly related. So when I draw a financial model using Excel sheet, I am trying to correlate two factors straight: the business operation versus the revenue generation. So it tells me where exactly I can draw a line and I can see my outputs coming faster. So if the organization is investing too much on plant layouts or on physical infrastructure, that means the depreciation also starts coming in. So my outputs would also have a free fall downwards. All these factors start coming in. So you need to calculate a lot of things before you put your foot firmly down and say that this is what I expect as revenue. 90% of the time we only look at a macro picture called as profit, and we believe that okay, things will happen automatically, but that's not true. Why? Because you have to calculate all the expenses, all the factors that come inside, and finally hit a button called as output and say that yes, this is possible. So what I would like to conclude on a nutshell is that the project sheet or the project financial module, what you are seeing there, is the live example or is the exact area where you're going to see that the financial modeling is happening. Now, what are the alternative model? There is a great argument that still continues in the financial sector. Why don't we switch from history versus forecast? Switched for the terminal period, switch for development period, construction period. There are so many switches on which I'm going to talk about. The first thing is that the word forecasting. This is very, very exciting for all of us today in the current business scenario. Moment I put in money, or even before the idea is set into a generation model, people ask this question: what is the return on investment? So that return on investment can be done only if we start moving towards the forecasting model. The forecasting model would start putting you into a zone where it will start asking you, how am I going to do this? Why should I always look at the history and keep repeating history? Rather, let me look into something more futuristic and let me say that this is what is going to happen 5 years or 10 years down the lane. So my general corporate model is moving away from a historical approach to a futuristic approach, a forward approach, where I would start trying to tell my investors this is what happened in the past and this is what is going to happen in the future. So I am trying to make my investors more proactive in thinking and make them understand finance is not going to be stagnant in terms of just holding it back, but it's going to be more futuristic where I'm going to push forward all the thought process. Terminal period. This is one very, very important factor that you have to understand. To what exact time period are we talking about? If I'm trying to talk about something which is called as the time factors or the time scenarios that starts coming inside, then I am trying to make an understanding, I'm trying to make a factual basis where I'm trying to tell about people what exactly we are trying to understand in that particular time period or time zone. See, when I switch to a terminal period, I'm typically talking about the timeline in which I would make my financial model. Is it for 1 year? Is it 2 years? Is it for 3 years? What is that I'm trying to look into when I'm talking about a terminal period time? So more the terminal period is accurate, or the more the time period are shorter in nature, then automatically I know my prediction will also be quicker, faster, and accurate. Now, when I move to a project financial model, this is very, very important. Why? Because we are going to talk about something called as development period. Now, a development period is very, very important. Why? Because development period is one which will start talking about how are you going to build the organization. Now, how am I going to build my organization still matters for most of us. Why? Because the development period is something that is more interesting initially and starts talking about the group factors, starts talking about more about the um, timeline period where I'm looking for an R&D, I'm looking for a growth perspective. And these things are very, very important in today's financial world because it is going to tell in what phases I'm going to develop the company. The construction period is the time for investment. That's how we put it across. Construction does not exactly mean, putting onto the infrastructure alone, but it is more about the time zone or that timeline in which I'm going to keep building the organization from investment point of view. So how much I'm going to take time in terms of building it, all that matters to a very great extent. So this would actually start understanding at some point of time that I'm trying to build an organization which would focus more upon something called as the operation timelines, the repayment timelines. All these things are going to be, a hand in glove model. These are all going to be closely linked to me, and I'm going to see that these operations are being taken care properly. So that is very, very important to us at this given stage. Unless and until we understand this clearly, we would not be able to develop a project financial model. Many a time, I also give this importance of saying that organizations need to focus upon this important factor called as debt repayment period. What's a debt repayment period? If I have to put it across in simple terms, how much time would I take to repay all my debts? This is very, very important. Why? Because if I don't do it, if I don't come up with a thought process like that, then what happens to me? That is seriously an issue, that is seriously an area which I need to think upon on a daily basis. If I don't do it, then where exactly I might land up. Now, this factor of analysis starts with a very simple question. Is my balance sheet more projected in terms of trying to end up finances faster and start becoming an ownership model, or is it more related in terms of keeping the liability for some time and then constructing out? That's where I start talking about leverage, buyouts, holding period, and terminal period, where I start seeing that how fast can I finish the debt of the company. Now, these are zones which I always talk about to my people, where I say that how much time we would take to manage the finance from one period to another time period, do the handholding for the company, and finally take the company to the next level as far as possible. So these are the switches what we are talking about. The switches are primarily basically the zones where you can move forward, do a alteration, do a mix and match, and start finding out what exactly works for you. Not every formula is good for all the companies. We cannot follow a thumb rule for all the companies, and we can't say that this is the static model. So using Excel, using the statistical models that are being given in the Excel sheet, we would be able to find out something called as an alternative models. Now, I'm going to get into the most important factor called as internal rate of return and the net present value kind of calculations using Excel. So let me just go on and start understanding the length of the corporate model. Now, the length of the corporate model is something which is very, very essential today. Why this is essential? Because your explicit forecast period should be, in theory, might be long enough for a company to reach a steady state. This is quite interesting to know. Why? Because when I make a presentation, I typically try to understand that, probably I'm putting words very clearly saying that in 10 or 15 years, I will return back your money and the company would come up to the next level as far as possible. But then the investor is not interested in that talk. He says that that is theoretical. Tell me practically what is the exact time frame in which you will return back the money. So the length of the corporate model is not just from a time factor, but it is more from a repayable factor. Now, I immediately go back to the statement trying to cover myself with this fact that, nobody really knows when the steady state will occur. This is something like, trying to cover up yourself. But then the fact remains that we cannot go with that cover up. So we have to come with a constant rate operating basis and tell those people that this is what we would be trying to come on a constant rate. The smartness of a finance manager comes here where he starts playing, on the roles where he does the under promise and over deliver. This is where I come to say. So if you are really smart, shrewd enough as a finance manager, you should go ahead and put out a value saying that probably we would be able to generate only 2 or 3%, but when you start working forward, you should expect a 5 or 6% growth kind of thing. And you should keep the capital expenditure at the minimum and try to start seeing those business areas where the investment or the return that comes out of the investments are faster. Now, there are a lot of people who do this analysis part of it, and they say that, probably you should have looked at more from a constant perspective, from this perspectives, from the areas of more thinking and other lines altogether. But let me put words here very simple. I would say that initially at this level, whenever you are starting a company, the lengthy forecast should be avoided, and you should start looking for a short-term forecast, okay? Because then only the financial modeling would also be easier, and you would be able to generate more value to your company, because we do not know what is kept for us in future. So what I'm trying to now build up here is the drivers and the working analysis pattern. I'm also going to look into a couple of dashboard, what are the indices that we are going to create, and the comparison with historic data and other matrices. Now, before I really get into it, I'm going to talk about three important factors: the capital expenditure, revenues, and operating expenses. I would like to go to a model here, and I would like to show what exactly it means before I come back to the theory part. Now let's look at this balance sheet here, which talks about the sophisticated Excel revenue things that can start coming inside. Actually, Excel will start helping you to create a template or a format. As you see on the screen, you would start seeing input summary, debt schedule, working capital, operating parameters, general input. So you can probably start making about some 50 or 100 kind of sheets on this and start talking about what are the links to each one of them. This is exactly where I would start selling the modeling is started. If you look through the balance sheet, I mean the graph Excel sheet there, you would start seeing that the base year is kept at 2001, and we are moving till 2009. So typically about 9 years kind of projection here, what we are going to see, with 2004 as the historical, and from there, from 2005, I'm getting into the projection part of it. Now, all these years which have been mentioned on the slides, on the things, are your values which are going to be inputted, and you're going to get some analysis done out of it. So on your left hand side of your Excel sheet, when you start seeing what are the key operating drivers, your revenues, your cash operating, each one of them have a tab, and that's like a macro file which is already inbuilt. I would like to take you to the next slide to make an clear expectation or drive out of it. Say, for example, the financial model that's been given in the database. You can see on your left hand side the assumption page with hyperlinks. This is how we would link the Excel sheet with the actual data that has been entered. So moment a person clicks on this, we go to a tab, it automatically calculates and puts across. How does this happen? If you go to the tab where on the Excel sheet where you would see the indication or symbol called as FX, the formula calculator, what we call, you will have a set of financial ratios which can be used in the macros, and automatically when you pull in this macros, you would start seeing what are the drivers, what are the factors that are coming out in terms of generation. This is exactly the assumption page that refers to a documentation from an investment analysis presentation. Now, this graph sheet, what we are trying to put here across, would start telling in what are the factors, parameters I have taken in for my presentation. For a moment, I would like to go back here and start telling you what is my model, which I'm trying to put in an example here. This model I have actually practically done for a business plan, and in fact, we did this some time back in terms of for a management fest, which I was a coordinator for that. So I have done for a telecom service business on which we did it. This was an example kind of thing which I would like to put across, and what we call this as the cash flow waterfall model in project finance. So this is how we are going to look into it. The project flow of funds, this is how the funds happen. One from the project operation and maintenance, second from the senior debt services. The debt services reserves, what we're going to keep. We are going to have debt. I would not like to go for the fourth point here because this is not typically applicable at the first level. And the various project reserves, and finally the returns to the project sponsor or who's going to be the investor kind of thing. Now, if I make it on a very simplistic way, what I'm looking here is that my first assumption in a financial modeling is that what is the money I'm going to generate out of operation and maintenance? What is going to be my debt and my expenses on which I'm going to build it? And what are the levels in which I'm going to create reserves? And finally, what we are going to give back to the project sponsor or the venture capitalist who's going to do it. So the structure involves these following cash flow mechanics. First is the operating cash. I begin with the net income. I add depreciation back to it to derive the operating cash. So I'm not going to get into the accounting part right now. I'm just going to go with the major subheadings. I'm going to start with my operating cash, then I'm going to get into my investments. I'm going to look into my financing part of it, and then I'm going to talk about the net cash flow. At the first level, when I, as I've told you, my operating cash kind of thing, I always look into the factor of what is my net income, and then I add back the depreciation to derive the operating cash. So this would give me exactly what is the money that is needed to run the operations, what I am going through in the system. Next, I look at my investments. Why? Because, at one point of time when I start investing money, I need to start looking whether, they are giving back money, or is it like a dead investment what a company is making. Is my prepaid expenses going up or decreasing? All these functions would start coming inside the cash flow mechanic. Then comes the financing part of it. This is very, very important. When I start talking about financing, what is the money that needs to be put across? Is there any need for new debt equities or debt issues? All these things have to be calculated, because if I want to make my company go public today, I need to be very clear what about my cash flow statement. Should I generate money through the equity shareholding? Would I be in a position to generate it back? All those structured calculations has to be done before which I start getting into this. So let me go back and ask this question to you. Um, any doubts, any questions here before I start going on to the next model or to the next levels? PPT. I would like to go on to the next stage where I'm talking about structure of inputs. This is very, very important for us today. The structure of inputs is something where I'm trying to talk about this factor, what all can be included in my thing. And this is not just about the coloring or putting across some thing, but this is more about a reference standpoint. Why? Because this coloring or whatever we are trying to put, this is more to indicate the company to tell very clearly what are the changes and what should not be changed kind of thing. So I'm going to put separate inputs that is going to be, on a yearly basis, monthly basis kind of things. And that's where I came to the Excel sheet to tell you what does the yellow color mean to you, or a red color means to you, or a blue color means to you. Why I specifically choose colors is that the colors are indicators to tell me what I mean by giving an input or a parameter. Is it about historical figures? It's about operating? Is it about cash flow? Is it about generation of new ideas or inputs? What is that we are trying to talk about? So the colors have a particular value and a particular indication. So we keep color as a very important factor in Excel sheets. Now, going forward, this is where exactly I want to talk about. If you start looking at my balance sheet on the screen, it typically talks about on an, I'm going more from an American model, not from a typical Indian model on the T-shaped kind of thing. I'm going on the American sized balance sheet where I'm talking about current assets, long-term assets, then I'm looking into the total number of assets, current liabilities, owner equity, I'm going down. What I'm trying to put here and trying to say here is that I'm trying to put in on a very, very, logical and sequential flow to make the investor understand about this factor. This is where my flow is going to be, and I'm taking the projection for the next, probably 8 or 10 years down the lane to tell me this is what can be arrived at in a long term kind of situation. So probably what the investors typically start looking inside is what are the current assets, the quality of assets, and what are the liabilities that are associated with that. And finally, they try to make an analysis what can be generated from this balance sheet. So when you are creating this balance sheet, one thing that needs to be very clear is that apart from the financial terminologies, the ethical systems of talking about that, I am trying to look into an area or a system that is trying to talk about the assets, the asset quality, the liabilities factors. So, what I'm trying to put in here is that please be transparent, ethical enough. Do not try to put in something which is beyond a kind of thing where you cannot try to put in something like fictitious kind of images or thing, because we try to do this. This is not something I'm pointing a finger at somebody, but this happens in our financial modeling and projection. I try to be a very you know nice enough in terms of putting those rosy figures and try to go to the investor and say that wow, it will happen in 5 years, it will happen in 3 years, or probably my qualities of asset is so good that I'll break even in a flash of a moment kind of thing. Please do not do that. Please be very clear enough in trying to go ahead and tell that particular person that yes, this is the challenge, these are what I'm looking into, and this is probably what can be generated. So when I start giving you the clear cut image or picture of assets versus liabilities, that tells the owners and that tells the investors that probably this is the company which is trying to tell us that development will happen stage by stage. So that is where we need a model which tells exactly what is going to happen in the long run. Now, this is another thing, the percentages and factors. When I calculate interest, please understand that whenever I'm putting a interest or whenever I'm putting a capex expenditure or some percentages here, that should be explicitly mentioned in the formula toolbar. So I'm trying to say the 10% or 9% or 11%, whatever is that you're going to put in, those factors on what the assumptions are being taken are should be the input should be clearly presented. That's what I say, percentages factors should be within the input. So whatever assumptions I'm making, I'm suddenly coming and telling my capital expenditure would go on 10% every year. Please indicate that 10% on the sheet. Do not keep it as a imaginary figure and try to project and just give me the final figure on the sheet. That would not work out, because people will ask, how did you arrive at that calculation? So you have to be very clear enough in giving where I'm doing it, how am I doing it. That's very, very important for us. So please put on very clearly saying that capital expenditure will go by 10%, probably my logistics expenses will go by 15%, my operations will go up by 12%. The indicators are very, very important. Give them a particular color, give them a particular subheading, and tell them where you are trying to work out. And there'll be a sensitivity analysis, which means to say that what is the level on which I'm going to work out. That's what in my next sheet I'm clearly giving it out. Show the percentages in a separate line or an item where I'm trying to tell these are my totals, these are my things, and these are my sub values under which I've been given. So this is my total capital expenditure, and this is what is going to happen. I've probably taken it at the 90% level margin here, and I'm trying to put a value here to tell people this is what is going to be my exact cost factors. This is another thing which I always like to talk about. The use of Excel in financial modeling is simply fantastic. Why? Because when you do it on a normal sheet, you just write down the values. But when you do it on an Excel sheet, you can also find out how a person has arrived at that particular value. So that's where you would start seeing that the input in formulas would start giving you what columns have been used, what values have been used, and at what rate it has been used. This will exactly tell you that this is what we have tried to arrive at this level at this picture. So this is one of the biggest advantages of using Excel and the financial modeling factor that comes inside. This is not something which is going to be a magic kind of thing, but this involves more of a logic. So whichever formula I'm using, for example, I'm using a some value here, I'm trying to arrive at an internal rate of return. All these things would be indicated in your Excel sheet, and if the projection is wrong, automatically it shows with an asterisk with a red color that the inputs are wrong. probably and the output is not coming in. So the Excel will give you a clear indication, are we going on the right track or not? These are the multiple toolbars and location. We can use a beautiful method like a straight line method or a continuous method, rigorous method. All these kind of things could be used in your Excel, which could exactly tell you what is the residual value, what is the tax percentage, what is your depreciation that's going to come you. So your Excel will allow you to revise inputs in multiple locations using the different toolbars and the combo box, the spinner box, scroll bar, whatever is that. This allows that the inputs can be kept together, can be adjusted so that you get the exact effect on the screen. Probably what we need to understand about Excel is that this is something which works exactly on the input what we give, and this does not works automatically. So the way how you design your Excel sheet is much more important rather than just putting in the numbers there and looking in for a final answer. If you design your Excel properly, automatically the output will also be great. These are some of the illustrations which I would like to show down today. How is the historic revenue that is being generated, and what is the revenue analysis I have done here. This is an example which I had taken from an airlines company which I would like to talk about. Probably a unique business of its own kind, where we start looking into the passenger volume, we start looking into the traffic that has been generated, the cargo business and everything, and you can see what are the revenues that are being generated at different levels at the different data, and there have been colors given to it to indicate the value here. This is typically about the expense sheet. I've continued with the same example here. What are the operating costs? What are the staff costs, food, beverage, sales costs? So, I can start putting in one by one sheet, which talks only about cost, which talks only about expenditure, which talks about cash flow, which talks about maintenance, which talks about the projection. So, this would actually help me to understand where exactly I am making changes and how these are linked. So anybody who opens the Excel sheet would be pretty much easy to understand what I'm trying to express or what I'm trying to tell across to the board. With this, I would come to the conclusion of today's exercise, where I have, trying to talk about financial modeling and exercise using Excel sheet. These are some of the illustrations. These are some of the examples which I'd like to put across. And that is the concluding slide for today. Any questions, any doubts here before I say a complete thank you to all? Okay, if there are no questions or anything, I would like to thank everybody for joining me today on this wonderful course called Financial Modeling through Excel. I would like to thank SMIB School for providing me an opportunity to present this PPT. And I would like to thank everybody for their time and patience in terms of understanding this model. Thank you once again, and hope to see you again in this platform. Thank you,
Thank you,
everybody.
Professor. Thank you for the insights on the financial modeling using Excel sheets. It was definitely useful to all of us.
Thank you,
And
ma'am.
thank you again for making this happen for us in such a short notice,
Okay,
and
thank you.
for being available to us as soon as we requested.
Thank you.
We really appreciate your gesture.
Thanks.
Thanks to all the participants for being on the call. I'm sure it was useful to all of you, and you were able to learn something out of the webinar today. Looking forward to meeting you all again next week in the
Right.
next webinar, same time next week. Thank you. Bye.
Thank you, ma'am.